The economy is crashing, but markets are highs at all times. You see it everywhere, life stacking up. Credit cards are maxed out, people drowning in debt. Economists are screaming this is gonna be worse than 2008. And honestly, it makes sense. When the real economy looks this bad, markets should crash. They always crash, right? But what if they don't? What if something fundamental has changed? Something that's keeping markets alive, even as the economy collapses underneath it. Now, I've been building and selling tech companies for decades through multiple boom and bust markets. Today, I'm a partner at a leading Bitcoin venture fund. And in this video, I'm gonna show you the one chart that we're looking at that proves this market has disconnected from reality. And what we're doing about it, and so should you. So let's go. The economy's crashing, but the market's all-time highs, right? You feel it everywhere. Friends are getting laid off. Groceries are costing more every week. Credit cards are being maxed out. People are just trying to make it to the end of the month. And meanwhile, Wall Street's celebrating new highs, record profits. CNBC's talking about, like everything's finite doesn't add up. Every economist out there keeps calling for a crash, some saying worse than 2008. And when you look around, it's hard not to agree. Because the real economy, the one you and I actually live in it, is breaking apart. You're watching the middle class get squeezed harder than ever. And somehow the market keeps celebrating like everything is fine. And all of the experts keep saying, don't worry, it's just noise. But it's not just noise, it's the sound of a system splitting in two. Here's what's really going on. There's the physical economy that's the world you and I actually live in. And then there's the financial economy, the world that runs on liquid algorithms and beliefs. Now those two used to move together. They used to work together, but now they're breaking apart. And that disconnects between Main Street and Wall Street. It's not just a glitch in the system, that's the final phase of the system. Okay, so let's start with the world that you actually live in. Right, not the one that lives in CNBC. Because in your world, things feel light. Groceries, right, they cost more. Credit cards, they're going up, maybe getting maxed out. It seems like every week another big company announces layoffs. And yet somehow, as I said earlier, markets are still highs at all times. Let's break all this down, because the real economy, the one that you and I live in, is quietly falling apart underneath it, right? You can see item companies that are supposed to be bulletproof. The ones that make the stuff you buy every week. We call them consumer staples because they're staples because we need them. But look, Clorox is down nearly 40% from its 2020 to peak. Kraft Heinz is down 30% just this year. Procter & Gamble's definition of a boring, reliable company. General Mills is down 20% and lost more than 1/3 of its value just this year. Now these aren't luxury brands, right? They're not tech companies. They sell soap, cereal, they sell cleaning supplies, like the most essential stuff in your pantry. And if they're collapsing, it tells you something must be breaking, something at the foundation. Now meanwhile, the Americans consumer, that's the engine that powers the economy. That's powered the economy for 80 years. They're completely tapped out. Credit card balances hit a record whopping $13 trillion this year. I mean, that's not spending on vacations or upgrades, that's people using plastic just to get by. Now the average interest rate over 24%, it's the highest in history. Delinquencies are now the worst that we've seen since 2012. The median checking balance is now down about 40% since 2021. That means the savings are gone. That means people are floating their lives on revolving debt. Now we see the same story with cars. Auto loan delinquencies just hit their highest level since the 2009 crisis. Repossessions, they're up 20% year over year. The average new car pay now over $740 a month. I mean, that's insane for a car. And when you can't borrow anymore, what happens when there's no more buyers? Demand collapse, things go down, right? That's why we're seeing layoffs. That's why we're seeing it spread everywhere, not just in tech. UPS cuts nearly 50,000 jobs and GM lets go of thousands. Starbucks axed 5,000 corporate roles targets, shut down stores, they cut management. Even Amazon and even Nike are back to efficiency rounds. Now in companies that depend on everyday spending when they start cutting workers, it's because people have stopped buying. Now real wages, they're also flat. The savings rate, it's near record lows. Mortgage delinquencies are up 20% year over year. Nearly half of renters are now spending over 30% of their income just to keep a roof over their head. I mean, this is part that people on Wall Street don't want to talk about, right? They don't want to talk about the physical economy and how it's actually seizing up middle class. They're the group that used to fuel growth through the spending that are now running on fumes. The model that worked from 1950 to 2020 grew through consumption and credit, it's all breaking down. The system can't expand anymore because people holding it up, they're broke. But yet the markets, they don't notice it. Markets keep going up. So how is this possible? Well, because there's now two economies. There's the one that you live in and the one that Wall Street trades on. And only one of them still matters to the system. And this is where the story splits in two. We have the real economy that's clearly breaking down. And then we have the second economy that looks unstoppable, right? The old rule was don't fight the feds. The new rule is don't fight the narrative. Because that's exactly what's running the markets right now. It's all running on belief. If you just watch the headlines, the AMP 500 looks like it's booming. But if you pull up the equal-weighted version where each company counts the same, you're gonna see that it's barely even moved. It's not 500 companies that are rallying, it's 5. Reuters said it straight, these said quotes. A relatively small number of large stocks are propelling the market, ending quote. And those are the AI giants. We're talking video, we're talking Apple, Microsoft, Amazon, Google, Meta, Tesla. By October 2023, just 7 companies made up about 1/3 of the entire S&P 500. Nvidia alone was close to 8% of the whole index, the largest weight of any company that we've ever seen. That means that when Nvidia moves, just say 1%, it can move your entire retirement account. That's how narrow this really is. And it's all built around a single artificial intelligence. AI has become the lifeline of the entire market. Every earnings call, every headline, every valuation, every story ties back to AI. Now at one point this year, roughly half of all S&P 500 gains came from a handful of AI-linked names. Half, not 75, not 60, half. I mean, that's massive for an index that size. And here's the wild part. AI isn't just a story, it's becoming the new stimulus. Total capital spending for S&P companies hit around $12 trillion this year, the highest since records began back in the 90s. Almost a third of that is coming from the same nina companies building AI infrastructure. So even when consumer demand is flat, corporate investment in AI keeps GDP expectations alive. That's why valuations stay up. Not because of today's profits, but because of tomorrow's hope. You see, Wall Street isn't trading reality anymore, it's trading belief. The index isn't pricing current demand. It's pricing a story about future productivity. Capital doesn't need consumers right now. It needs conviction, it needs belief. As long as investors believe that AI is the future, then money's gonna keep flowing in, even while the real economy struggles to breathe. That's the synthetic economy. It's not driven by spending, it's not driven by production anymore. It's driven by story, and for now that story's powerful. It's powerful enough to keep the whole illusion alive. But stories can only sustain belief for so long. But what happens when that belief turns into policy? What happens when markets stop being free and become fully fiat? Well, for 80 years the formula was simple. You go to work, you earn money, you spend it. And that spending drives the production, which then creates profits. And markets consumption-powered growth. But now the whole sequence has completely flipped. Just in October, the Fed didn't just cut rates again. They also hit pause on quantitative tightening. That's a central bank code for we're not going to drain liquidity anymore. And liquidity is what lifts the asset prices. The BIS even said that global financial conditions ceased this summer because equities went up. And credit spreads tighten. In other words, markets themselves become the stimulus. We're now on a loop where bad news means more cuts, more liquidity, and then higher prices. So bad news is kind of good news. Weak jobs data, market rallies, slowing economy, more easing. Every data miss just feeds the next leg higher. That's the inversion that we're seeing. The economy used to drive the markets. No, the markets drove the economy. Today, corporations are the biggest buyers of their own stock. About $1 trillion in buybacks just this year alone, and not consumers, not foreign investors. Companies using cheap capital to push their own stock prices higher. Now the Fed provides the liquidity. Wall Street channels it through corporate balance sheets, and stock prices keep going up. Even the central bank's researchers admitted. The programs like the Banking Terms Funding Program lowered perceived banking risk rates. It was never about fixing the system. It was never about fixing the fundamentals. It was about protecting consumer confidence. In the story, in the belief, because belief itself is now the policy tool, right? Today, just 7 companies control more than 30% of the entire S&P 500. And analysts keep raising their year-end targets because of AI, enthusiasm, and easing Fed policy. Again, it's not earnings doing this, it's narrative. This is the new model: belief, liquidity, markets, and production. That's why I call it a fiat marketing, right? Because just like our money, it's backed by confidence, not collateral. As long as the story holds, system stays alive. Which is why I've been making video after video for the last at least several years, warning. The danger now isn't a crash down, it's not a deflationary crash that most people are thinking of, but rather it's a crash up. Too much liquidity chasing too little substance. We have basically capital flooding into the last narrative standing. And while everyone keeps waiting for the crashes down, what we're getting is the crash up, right? It's the grand finale of the belief era. Because when you look at what's actually happening right now, the Fed's cutting rates. The halting liquidity is flooding back in. And we have trillions of dollars and buybacks happening. So it's hard not to see where this goes next. The same forces that inflated the bubble are now trying to keep the bubble alive. And when a system runs on belief and liquidity, the end never comes down as a crash. But this isn't some magical fairy tale ending. Let's be clear about this. This thing has two failure points. First, there's a liquidity crisis that could potentially happen. If the Fed decides to pull the liquidity away, right then the engine starts to sputter out. We just saw how fragile it is. The Fed had to pause its balance sheet runoff to stop liquidity from evaporating. The BIS even said, right, the market itself has become the transmission mechanism. The second risk is the belief crisis. If the AI narrative cracks, capital will fall back to reality really fast. Now the Meg 7, they control 30% of the S&P 500, right? So that's highly concentrated. We haven't seen that since the dot-com era. Analysts literally raised their 2025 targets to 6,400, 6,500 just on AI optimism alone, right? But if this story breaks, if AI earnings disappoint, or if productivity promises fades, doesn't materialize, an entire layer of belief collapses. But before either of those failures hit, we're likely to see at least one last surge. In my opinion, some might call it a meltdown, call it a crash up. Either way, we can see it right now, right? Liquidity is rushing back in, buybacks are running it, 11 trillion, the risk appetite's completely exploding. We just saw nearly 6 billion pouring into cryptos in a single week. Right, this is how late cycles behave. A policy loosens, flows accelerate. The leaders drag the index higher and everyone pretends it's a new boom. This is the window of opportunity, and the thing is, the winners won't be the ones that are combating system. They're gonna be the ones who understand its fiat, and they're gonna position themselves outside of it, because the fiat market runs on faith. Bitcoin, it runs on proof. Bitcoin supply doesn't change because of a median in DC, right? It's fixed 21 million coins, locked by code, and the hash rate that the hash powers the mining power world energy securing it. And it's at an all-time record high, right? That's why it matters. It's not a story, it's not a narrative, it's backed by math. Well, the belief economy melts up. I'm looking towards the next system, right? The one that's built on proof, not promises, because every time a fiat system ends, a new base layer rises from the ashes, and this time base layer is Bitcoin. Okay, so here's where we're at. The economy's weak. The market's detached in the systems running on fumes of belief and liquidity. That's the bad news. The good news is that you know it, right? The good news is that you know it. And it gives you a massive edge, right? You don't have to guess when it ends. You just need to understand how it works. You have to position yourself outside of the fiat loop before it breaks. Because what comes next isn't another cycle, it's the reset. And the people who prepare nowhere are going to be the ones who own the next system. And because nobody knows exactly when this crash up answer, how the reset actually plays out, it's super important that you have a system that works since both directions crash up and crash down. You don't have to care. That's why I built something called the crash proof income map. It's simple. It's a 1040-40-10 blueprint that shows you how to automate your money flow show to protect your income, how to keep stacking real assets even when the markets go crazy. It's an interactive guide. It's completely free. It's my gift to you. It takes about an hour to set up. And this is how you get off the roller coaster and build a wealth engine that runs on proofnet belief. So you can download it down below. I'll put a link in the description down below, or put a QR code up on the screen right here. Start building your crash-proof system today, because the next rate won't reward people who predict the markets. It's going to reward the ones who are ready for anything. And the crash-proof income map will make sure you're ready. And it's my free gift to you. So go ahead and grab it right now. And if you want to see, why do you believe there's a once-in-a-lifetime crash coming? Worse than 2008. Different than what most people think. Watch this video right here and I'll see you over there.